Okay, let's jump right in. Ichor Holdings supplies the absolutely critical internal subsystems for the machines that manufacture the world's most advanced chips. Now, you hear that and it sounds like a total no-brainer, right? An obvious high-leverage way to play the massive surge in AI infrastructure spending. But, well, here's the massive paradox at the heart of this company. Despite being literally essential to building AI hardware, Ichor has historically struggled with severe cyclicality and, honestly, pretty modest margins. Let's dive straight into this explainer and unpack what is actually going on here.
So, the crucial question we really need to figure out today is this. Is Ichor truly a differentiated, high-leverage beneficiary of this whole AI hardware boom, or are they kind of just a low-margin part supplier that's ultimately bound by massive customer concentration and weak pricing power?
To get to the bottom of that, we have to completely separate the overarching semiconductor hype from Ichor's actual on-the-ground financial exposure. We're looking at a pretty messy combination here: critical technology, extreme customer concentration, and highly cyclical margins. We've got to peel back these layers to see if their current growth is actually a sustainable structural change or just a temporary cyclical upswing that's going to eventually crash right back down.
Section 1. Inside the fab's plumbing. To really understand the investment case, we first need to know exactly what Ichor manufactures and where it sits in this incredibly complex supply chain.
Think of Ichor's products as literally the central circulatory and nervous system of a semiconductor fabrication machine. They don't make the actual chips, and they don't even make the massive machines that make the chips. Instead, they engineer these critical fluid and gas delivery subsystems. These are what feed exact, ultra-pure chemicals into the tools made by industry giants like Applied Materials and Lam Research.
So, what is a fluid delivery subsystem? It's a highly precise assembly of piping, mass flow controllers, and microvalves. Its job is to deliver highly reactive gases and chemicals into reaction chambers without a single trace of microcontamination. And I mean zero. Extreme purity and precision are absolutely non-negotiable here. A microsecond delay in a valve or just a tiny speck of particulate contamination, that can ruin an entire batch of wafers, costing a fab literally millions of dollars in lost yield. Because of that, the switching costs for this high-tech plumbing are incredibly high.
Section 2. The current growth catalysts. So why are intelligent retail investors suddenly paying so much attention to this specific stock right now? What's driving all this momentum?
30%. That is a massive number, and here's why it matters. As chip makers transition to new, highly advanced gate-all-around logic architectures, which, by the way, are completely essential for the AI stack, it requires a 30% increase in the actual number of process steps to manufacture the chip. And more steps? That means more etching, more deposition, and more exact chemical delivery. It massively multiplies the total addressable market for Ichor's complex subsystems on a per-tool basis.
And the crazy thing is, we're already seeing this translate into hard, independently verifiable evidence. Just look at Q1 2026. Revenue jumped 15% sequentially to $256.1 million. They absolutely crushed non-GAAP EPS expectations, posting 15 cents when everyone was expecting somewhere between 6 and 13 cents. But here's the absolute most important takeaway. That 15% revenue bump caused their Q1 operating income to triple sequentially to $8.7 million. Talk about extreme operating leverage. When demand rises, their profitability just skyrockets. Management even noted that unconstrained Q2 demand is already exceeding $300 million.
Section 3. The bull case, operating leverage. Let's look at the strongest credible argument for Ichor right now, which relies heavily on some recent, aggressive structural transformations.
All right, to really buy into this bull case, you have to separate the hard facts from management's sky-high ambitions. Fact: that very real Q1 2026 revenue ramp of $256.1 million we just talked about. But the target? Management is pointing toward a massive $2 billion annual run rate capacity. Now, reaching that assumes prolonged, completely unconstrained equipment demand. And as they've admitted on earnings calls, it's going to require some facility and equipment additions to actually hit that ceiling. But the foundation for that infrastructure is being laid right now.
So how are they actually improving profitability along the way? Well, Ichor recently went through a pretty painful but totally necessary geographic footprint consolidation. They shuttered these high-cost, inefficient legacy sites in Scotland and South Korea. Then they shifted high-volume cleanroom assembly over to specialized facilities in Penang and Shah Alam, Malaysia. And probably most crucially, they're vertically integrating their proprietary valve production completely in-house down in Nogales, Mexico. This whole push for vertical integration was heavily accelerated by some key acquisitions, like IMG Companies and Applied Fusion, which brought incredibly new skills like precision electron beam welding in-house. So instead of buying parts from a third party and just eating that markup, Ichor can now manufacture proprietary components, like their ultra-pure TMX C-seals, all by themselves. The goal here is huge, pushing toward a target of 35% Ichor-branded proprietary content per system. If they pull that off, it would structurally elevate their gross margins for good.
Section 4. The bear case. Structural vulnerabilities. Okay, time to flip the script. We need to examine the deep vulnerabilities that could keep Ichor permanently trapped as an ordinary cyclical supplier.
Because here is the absolute most terrifying risk for this company. Roughly 73% and sometimes as high as 76% of Ichor's total sales rely exclusively on rolling purchase orders from just two clients, Lam Research and Applied Materials. Think about that. If either of those giants loses market share, decides to dual source to drive down costs, or just insources their plumbing entirely, Ichor's revenue collapses. Being at the absolute mercy of two massive gorillas in the industry is a massive single point of failure.
To put this into perspective, let's compare Ichor directly to its main publicly traded competitor, Ultra Clean Holdings. Ultra Clean is a lot larger, doing over $2 billion in trailing revenue compared to Ichor's roughly $959 million. But look closer at the margins. Ultra Clean boasts a blended gross margin of around 16.5% in Q1 2026, while Ichor is sitting at 12.8%. Why the gap? Because Ultra Clean has a highly lucrative recurring services division with 30% margins. Ichor is entirely reliant on hardware manufacturing, which leaves it way more exposed to those violent boom-and-bust hardware cycles.
And honestly, the risks definitely don't stop at customer concentration. Because they have this massive fixed cost footprint, Ichor faces severe operating leverage downside during cyclical troughs. When orders slow down, their earnings absolutely crater. Plus, they don't really have pricing power against the powerful suppliers of the high-grade 316L stainless steel they need. Add in the geopolitical risks, where export restrictions that shrink tool shipments to China directly result in canceled orders for Ichor, and a newly elevated effective tax rate now that a Singapore tax holiday has expired. Yeah, the bear case is very, very tangible.
Section 5. Separating hype from reality. So how do we actually synthesize the undeniable hype of the AI semiconductor cycle with the hard, cold reality of Ichor's financial vulnerabilities?
Well, we follow the money. Here is a $200 million reality check for you. Management isn't just sitting back watching their stock price rise. They are using the current momentum to execute a $200 million at-the-market equity offering. This is a remarkably pragmatic, strategically sound move. By taking this capital and using it primarily to retire their variable interest term loan and deleverage their balance sheet right now, they are essentially building a financial fortress. They know they need protection when the cycle inevitably turns down again.
Which brings us to the ultimate question you should take away from this explainer today. Has Ichor's localized manufacturing in Mexico and Malaysia, combined with this aggressive push for proprietary components, fundamentally transformed the company into a high-margin powerhouse? Or, despite riding the massive AI infrastructure wave, are they ultimately destined to remain a highly concentrated cyclical supplier? It's a fascinating paradox, and for sure, it's one you are going to want to watch incredibly closely as this capital equipment cycle peaks.